Welcome back to the channel. My name is Steven. I own 52 units of real estate and I'm a pharmacist. So lately I've been seeing in the news a lot about interest rates going down over the next, 2 years. So interest rates are expected to drop in 2025 and drop again in 2026 by maybe about 1%. So right now it's, I don't know, I think average about maybe 7%, let's just say, and then maybe next year it'll be 6% and then 5%, right? And to me, if that's truly the case, like this is my prediction in terms of how it's going to affect real estate, right? So let's first relate that to single family homes. So obviously for me, I bought my single family home here at a 6.5% interest rate. So if in like 2 years it drops down to 4.5% and I'm able to do a refinance, it's gonna do two things for me. So if interest rates do drop down to 4.5%, what's gonna happen again? More buyers will go into the market, right? Like because homes become more affordable, because interest rates are lower. But what happens is when interest rates drop, people start to overbid for real estate again. Like remember during COVID when interest rates were like 2.5%, and people were bidding 100, 200, $300,000 over asking because they can afford it, right? Because interest rates were 2.5 versus like 4.5, right? And the same thing will happen again. Like every time interest rates drop a percent, more buyers will come and people will start overbidding. So it's great for those who own real estate, right? Because like for me, if I own real estate, let's just say my single family homes that I already bought a while back, and I have great interest rates, right? Like 3% is kind of my average interest rate on those homes. And let's just say if I lock that in already, all the neighboring houses, if they go on for sale because interest rates are lower, it's gonna overbid, right? So it's gonna raise the value of my real estate portfolio. It's gonna increase my net worth, right? And then for those who bought after COVID, like I bought after COVID, and the interest rate is 6.5%, what was everyone gonna do? They're just gonna do a refinance and lower their interest rate, right? And what happens when I lower my interest rate is it makes it more affordable for me now, right? So let's just say hypothetically I pay $7,500 a month all in, right? Everything: property tax, HOA, insurance, utilities, mortgage, interest, all that, right? But if I'm able to add a 6.5% interest rate, if I were to lower it to like let's just say 4.5%, I might save $1,000 a month in terms of my principal and interest payments, or $1,500 a month, right? Like whatever that looks like. So now it's cheaper for me, but also on top of that, all the homes around me are selling for a higher price because now people can afford a higher price, right? So, for example, I bought a new build construction. So if interest rates were to drop every year, they've completed 8 phases, and I bought in phase four. And every phase 5, phase 6, phase 7, phase 8, the prices have gone up. So I've built equity. And once phase 8 is done, that's halfway done, they're going to develop the other half, right? So there'll be another 8 phases. So imagine by that time, the next 8 phases are phase 8 to 16 is being worked on. If interest rates drop simultaneously, they're going to list the price house at a higher price. I'm going to get more equity. Plus, on top of that, I'm able to refinance and lower my interest rate, which saves me money. So it's a double win, right? Not only am I paying less now because of lower interest rates, but now the value goes up because people are overbidding for properties again, right? So um, that's kind of the double-edged sword. So the key is you should buy real estate regardless of interest rates, if assuming you can afford it and if it makes sense, right? So you have to kind of pick your poison, right? Like if you have very low interest rates, yes, you'll have an affordable, good interest rate, but people are going to overbid for properties, so it's more competitive. Or in a high interest rate market, uh, you may not have to overbid, right? But now your interest rate's higher, so you have a higher monthly payment. So the key is you want to buy right and buy when it makes sense, right? Like, can you afford it? Like, I can't afford it because I work at W2. And can you afford to hold this real estate long term? And by long term, I mean at least 7 years, 7 to 10 years. Because for me, his primary residence, right? I bought it at market price for 900,000. I locked in a 6.5% interest rate, but I'm planning on living here for at least like 7 to 10 years, right? Like our jobs are, it's in a great location. It's near our jobs. It's by a great school district. So if we have kids one day, they can go to that school. So like my kid can live here until like basically middle school. Once they go to middle school, high school, the school is not as great, or maybe it'll gentrify by then. That case, we have to move potentially, right? But that's 10 years. So like by then, will interest rates be less than 6.5%? I'd hope so. And would the value be higher in 10 years? Probably, right? So like once you hold it long term, you can't lose, right? Because when you hold it long term, even if you locked in a high interest rate, like I said, I'm going to refinance it to a 4.5% interest rate, lowers my monthly costs, and all the houses around me are overbidded. So in that case, I get market appreciation, right? And now, so that's for a single family in a high cost living market like California. Now let's go to multifamily. So if interest rates drop, what does that do? That's going to lower your cap rate. If you lower your cap rate, it's going to increase your value, right? So, for example, because interest rates are, let's just say 6, 7, 8% for multifamily, 5+ units, your cap rate has to be 8 to 10%. That's how lenders are going to underwrite it, unfortunately. So, but if interest rates are, let's say 4%, then they can have a lower cap rate to have that margin. So, so if interest rates drop, my cap rate will drop, my values will go up, right? And then if that's the case, then um, that's how you make money as well, right? So like the key is like if you hold real estate long enough, long term, and assuming it's a good location with good tenants, with good property management in place, and you have other sources of income to offset that, and you're able to have a long term outlook on real estate, like it's hard to really lose, right? You have to think long term, right? It's not instant gratification. If you told me when I was 27 years old that when I'm 34 I own 52 units, I'd say I'm retired. But fast forward to 2024, I'm still working, right? And I'm trying to build more side businesses to get more streams of income, right? Become a real estate broker, do my coaching, my mentorship, create social media, all that stuff, right? So, because I realized that number one, you need that money to sustain your real estate, right? And number two is that the point of real estate is to hold it as long as possible, and it makes you asset rich, cash poor, right? And I'm the definition of that. A lot of real estate investors are the definition of that. So, because of that, I still need my W 2 to get that cash flow coming in, right? And I need to focus on building businesses to get that cash flow coming in. So, so that's kind of my thoughts on interest rates, right? So, like you said, pick your poison, right? Like right now, high interest rates sucks, but you don't have to overbid for properties. So if you can buy it and hold out, and you plan on staying there long term, then it may make sense to buy it. And then once the rates drop, you just refinance, lower your rate, lower your monthly costs, and then everyone starts overbidding for properties again, and then you get that instant equity for single family homes. For multifamily, like my 20 unit, I refinanced it at a time where the hard money loan was 9% and my interest rate is 6.5% conventional, right? So whenever interest rates drop to like 4%, I'm gonna do a cash out refinance, right? I'm gonna lower my interest rate, pull out a bunch of money, and then go buy another apartment complex, right? And then at that point, the values will go up because interest rates drop, cap rates drop, values go up. Because remember, it's NOI divided by market cap rate. So that's how you kind of do it, right? That's how you play real estate long term. That's why it's a long term game, right? You have to go through these cycles, right? Like I said, pick your poison. Do you want to have low interest rates and people overbidding, or do you want a higher payment and then eventually you have to just refinance it when it lowers? So pick your poison, right? And the way to beat all that is just consistently buy real estate, like dollar cost average real estate over time. Like buy every year, like me. I bought in 2017, 2019, 2020, 2021, 2022. I refinanced in 2023. I bought in 2024. Like I've consistently done real estate over that time window, right? So, you know, if you're interested in jumping into your first multifamily deal, check out the mentorship program down below. Let me know if you have any questions or comments. Please share this video with somebody. Like, comment, subscribe. I hope to see you next one. Thank you.